He who lives by the crystal ball will eat shattered glass. Know all the possibilities, think about the worst-case scenarios, and then find ways to eliminate the intolerable ones. The most important thing in playing the game is to not get knocked out of it. That quote comes from Ray Dalio, the founder of Bridgewater Associates and the man who built the largest hedge fund in the world. And right now, almost everyone in crypto is doing the exact opposite of what Dalio warns about. Every crypto video, every Twitter thread, every analyst on television, they're all trying to predict what the Federal Reserve will do on March 18th. Will the Fed cut rates? Will they hold? Will the dot plot shift? Will Jerome Powell signal that rate cuts are coming soon? Everyone is staring into the crystal ball, trying to predict what the Fed will say. But Dalio's entire philosophy is built on a very different idea. Prediction is fragile. Preparation is powerful. Because markets have a habit of humiliating investors who bet everything on one outcome. And right now we are heading into what could be the most dangerous Federal Reserve meeting for Bitcoin in 2026, not because of the rate decision itself, but because of the message the Fed will send about the future. So in this video, we're not going to try to predict the Fed. Instead, we're going to do what Ray Dalio says smart investors should always do. Prepare for every possible scenario, and make sure that no matter what Powell says this week, it doesn't knock you out of the game. Before we dive in, don't forget to like this video and subscribe for more analysis like this. Now let's get into it. The Federal Reserve meets March 17th and 18th. And if you've been in crypto long enough, you already know that Fed meetings can be extremely volatile events for Bitcoin. But what most investors don't realize is how consistent the pattern has been recently. Since 2025, Bitcoin has sold off after 7 of the last 8 FOMC meetings, 7 out of 8. And what's fascinating is that these sell-offs often happen even when the outcome of the meeting is completely expected. In other words, the market already knows what the Fed is going to do. And yet Bitcoin still drops. The clearest example happened earlier this year. At the January FOMC meeting, the Federal Reserve held rates steady exactly as expected. There was no surprise, no unexpected change. And yet within 48 hours, Bitcoin fell from roughly $90,000 down to $83,000, a sharp $7,000 drop, which raises an important question. Why does Bitcoin react this way even when the rate decision is already priced in? The answer is simple. The rate decision itself is rarely the real trade. The real trade is Powell's language. Every word the Fed chair speaks about inflation, growth, and future policy changes the market's expectations. And expectations are what move markets. This time, Powell faces a particularly complicated situation because the macro environment has changed dramatically since the last meeting. 3 new shocks have entered the global economy. First, the escalation of tensions involving Iran. Second, oil prices rising above $100 per barrel, which increases inflation pressure across the entire economy. And third, the political shock of Trump proposing a 15% global tariff policy. All 3 of these forces could push inflation higher, and if inflation rises again, the Federal Reserve may not be able to cut interest rates anytime soon. Which brings us to one of Ray Dalio's most important insights about markets. It all comes down to interest rates. As an investor, all you're doing is putting up a lump sum payment for a future cash flow. The big question is, when will the term structure of interest rates change? He who lives by the crystal ball will eat shattered glass. Interest rates are the gravitational force of financial markets. They determine how capital flows. They determine how risk assets are priced. And increasingly, they influence the trajectory of Bitcoin. So trying to predict the Fed is extremely dangerous, which is exactly why Dalio recommends a different approach. Prepare for every outcome. Ray Dalio has spent decades studying economic cycles. He's managed money through inflation crises, recessions, financial bubbles, and geopolitical shocks. And the lesson he emphasizes repeatedly is this: no investor ever knows the future with certainty. Even the smartest people in the world are constantly surprised by unexpected events. Dalio addressed this idea directly during a talk at the Milken Institute Asia Summit. I would like to have diversification because what I don't know is going to be much greater than what I do know. That statement captures one of the most important truths in investing. The unknown will always be bigger than the known, which means the smartest strategy isn't prediction. It's preparation. Instead of trying to guess what Powell will say this week, we can map out the possible scenarios and build a plan for each one. There are three realistic outcomes investors should consider: a dovish surprise, a neutral hold, or a hawkish shock. Let's start with the most bullish scenario: a dovish surprise from the Federal Reserve. This would happen if the Fed signals that 2 interest rate cuts could occur in 2026. The key signal would come from the Fed's dot plot. The dot plot is essentially the Fed's forecast for future interest rates. Each policymaker places a dot representing where they expect interest rates to be in the future. When those dots move downward, it signals that the Fed expects to ease policy. And easing policy means one thing for financial markets: more liquidity. Liquidity is the lifeblood of risk assets. When borrowing becomes cheaper and financial conditions loosen, capital tends to flow toward assets like stocks, technology, and increasingly Bitcoin. So if the dot plot suddenly signals 2 rate cuts instead of 1, markets would likely react very quickly. Bitcoin could break $75,000 almost immediately, and a rapid move toward $80,000 would become possible. The reason this move could be violent is because most traders are not positioned for it. Oil above $100 normally pushes the Fed toward a more cautious stance. So if Powell surprises the market with a dovish tone despite those inflation risks, traders may scramble to reposition. And that kind of repositioning often creates fast price moves. But again, this scenario is not the one investors should blindly bet on. Dalio's rule is simple: prepare for the possibility, but never rely on it. Now let's talk about the most likely outcome: a neutral hold. This is the scenario the market currently expects. Interest rates remain unchanged. The dot plot still shows 1 rate cut in 2026, and Powell delivers a cautious message without signaling major changes. According to the CME FedWatch tool, the probability of this outcome is above 90%, which means markets have already priced it in. But here's the danger: Bitcoin has historically sold off even when the expected outcome occurs. This phenomenon is often called the sell the news effect. Markets rally leading into major events as traders position themselves for the announcement. But once the announcement actually arrives, traders begin taking profits. That profit-taking can trigger temporary declines. If that pattern repeats this week, Bitcoin could drop toward the $67,000 to $68,000 range in the 24 to 48 hours after Powell speaks. But here's where Dalio's philosophy becomes incredibly useful, because moments of panic often create opportunities. At the January FOMC meeting, Bitcoin dropped sharply after the announcement. Many traders assumed the market was about to enter a deeper correction. But roughly 2 days later, the selling pressure faded and price began to recover. The bottom formed approximately 48 hours after Powell spoke, which suggests something important. Sometimes the most attractive entry points appear right after markets panic, and that connects directly to another Dalio principle. Investors should learn to think differently from the crowd, because the crowd tends to react emotionally. Disciplined investors prepare for volatility instead of fearing it. Now let's consider the worst-case scenario: a hawkish shock from the Federal Reserve. This would happen if the Fed signals 0 rate cuts in 2026. Or worse, hints that additional tightening could become necessary. Why would the Fed do that? Because inflation risks might be rising again. Oil above $100 increases costs across the global economy. Transportation becomes more expensive. Manufacturing becomes more expensive. Food prices begin rising, and inflation pressure spreads through supply chains. If the Fed believes inflation could re-accelerate, Powell may signal that rates must remain higher for longer. That would be a negative shock for risk assets, and Bitcoin could drop toward $62,000 to $65,000. A move like that would likely trigger liquidations across leveraged crypto positions. But this is exactly the type of outcome Ray Dalio says investors must prepare for. You don't have to predict whether it will happen. You simply need to ensure it doesn't destroy your portfolio if it does. That could mean holding cash reserves, reducing leverage, or managing position sizes carefully. Because Dalio's most important rule is simple: the goal is not just to make money. The goal is to stay in the game long enough to benefit from future opportunities. Now here's the interesting twist. Underneath all 3 scenarios, a signal is emerging in the Bitcoin derivatives market that many investors are overlooking. Bitcoin futures funding rates have been negative for 14 consecutive days. That's the longest negative streak since December 2022. And December 2022 was one of the darkest periods in crypto history. That was the aftermath of the FTX collapse. Bitcoin was trading near $16,000, and sentiment was extremely bearish. Funding rates measure the payments between traders holding long and short positions in perpetual futures markets. When funding rates turn negative, it means short sellers are paying long traders. In simple terms, it means the market is heavily positioned for price declines. But historically, every time funding rates have stayed negative this long, it has coincided with a local bottom forming in the Bitcoin market, and the market becomes vulnerable to a reversal. Because if price begins to rise unexpectedly, short sellers are forced to close their positions. And those forced purchases can drive prices higher very quickly. So even if the Fed meeting causes a short-term drop, the underlying positioning suggests the market may already be primed for a rebound. There's another signal reinforcing that idea. The crypto fear and greed index currently sits around 23. That level represents extreme fear. And historically, extreme fear tends to appear near market bottoms rather than market tops. What's fascinating is that despite this fear, Bitcoin recently touched $74,000, and the price is roughly 8% higher since the conflict began. So why do investors feel so pessimistic? Because human psychology tends to extrapolate recent trends into the future. And recently, the crypto market has experienced 5 consecutive months of declines. When investors see that pattern, they naturally assume the next month will look exactly the same. But Ray Dalio has warned about that exact mistake. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. They assume that something that was a good investment in the recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is a poorer, not better, investment. Markets rarely move in straight lines. Cycles of fear and optimism constantly replace each other, and the turning points often occur when confidence is lowest. Which brings us back to Ray Dalio's final principle. Do the opposite of most people, which is to sell in bubbles and buy in busts. Right now, the market is surrounded by uncertainty. War headlines dominate the news. Oil prices are rising. The Federal Reserve meeting is approaching. And investors feel nervous. Most people respond to this environment by freezing or panicking. But Dalio's framework suggests a different approach. This is exactly when preparation becomes most valuable. You don't need to predict Powell. You don't need to guess what the Fed will say. And you don't need to know whether Bitcoin moves to $80,000 or $65,000 next week. You simply need a plan. A plan for the bullish scenario, a plan for the neutral scenario, and a plan for the worst-case scenario. Because the investors who survive turbulent markets are not the ones who predicted every event correctly. They are the ones who prepared for uncertainty. So as this Federal Reserve meeting approaches, remember Dalio's rule. Don't stare into the crystal ball. Prepare for every possibility, and make sure that no single Fed decision can knock you out of the game. In the end, the smartest investors don't rely on predictions. They prepare for every scenario. How are you positioning for this Fed meeting? Let us know below. And if you found this useful, like, share, and subscribe for more breakdowns like this.